Hello, Bisons. In today's video, I want to introduce you guys to a little bit more of an advanced concept. Now, the law of causality exists in the markets. What does that mean? There is a cause and effect relationship between the candles individually and between the moves as they happen from swing point to swing point. Okay? Now, I want you to bring your attention to the highs and the lows, not just the swing highs, but each individual candle. What do you see? Well, if we're looking for a cause and effect relationship, then we are observing to see which level is more repulsive. What does that mean? Each time that the market trades to the low of a range or the high of a range, it is taking liquidity. We also know that there are two likely outcomes when the market is at a liquidity pool: reversal or continuation. But what will give us this information that we need so that we can take advantage of these moves? This is it, you guys. The cause and effect relationship between the candles, between or happening at these swing points. Okay? To put it very simply, if the market is taking liquidity below the lows and that causes the reversal to go to the high of the candle, then we can say that the lows are more repulsive. Vice versa, if the market trades to the high of a candle and it has that reversal, making it back to the low of the candle or to the low of the range, then we can say that the highs are more repulsive. And from this information, we can use this to help us to choose better levels to get into our trades. A little bit of an embedded technique to layer on top of what we have been learning so far. To demonstrate that for you guys, we're just going to go over this price fractal that we have right here. Okay, now we're going to start at the top right here. And like I said, you guys, we're going to be monitoring what happens when the market trades to a low of a candle, what happens when the market trades to the low of a range for this down move, and then we're going to do the opposite and we're going to look what happens when the market trades to a high for this up move, so you guys can see both sides of what I'm talking about right here. Okay, now starting at the top with this candle right here, we notice that we do have a swing low right here, liquidity resting below these lows over here. Okay, we're going to be going over each individual candle to see what happens when the market trades to the high or the low of the previous candle. Now, once we have this candle open, we notice it is already opening at the low, and we have this high volume relative to the move before trading all the way down. We do have market taking liquidity below this low. Remember, you guys, there is internal range liquidity and there is external range liquidity. Internal range liquidity is resting below each individual low, moving higher. In this case, it is an up move, so you have liquidity resting below this low, internal range. You have internal range liquidity resting below this low and also this low right here. Okay, so once we take liquidity below this one right here, we would have also traded below all of these lows already. Now look what happens. There is a slight reversal. However, notice that this candle right here that took liquidity, I'm just going to go ahead and highlight, just mention the high. Notice the market is not making it back to these highs right here. Okay, what does that mean? The lows are not repulsive, you guys. That's what that means. The lows are not repulsive. If we are taking liquidity, if we understand that two things happen when the market trades to a liquidity pool, like we stated earlier, continuation or reversal. Okay, now reversal is going to be, most of the times it's going to be quick. Sometimes you will have a little bit of a slowing down, a little bit of a consolidation for a deeper dive into those liquidity pools, but more often than not, you will find reversal to be quick, rapid movement away from these levels. So once we have the market trade to this level right here, even though we do not have the market closing, so we do not label this as a shift in market structure or break in market structure or anything. However, we pay attention to the high that caused the liquidity run. Okay, now notice what happens on the subsequent candles. It did not trade to the low, this candle right here did not take the low. There is no liquidity taken right here, and it also did not make it to the high. Okay, on the subsequent candle, notice we have market trading above the high, but then there was no movement. So we're just going to skip out a couple of candles, and once we get to this one, we see that the market ever so slightly trades above the high on our first candle that did take liquidity. And this is what I mean, you guys. You will notice that it is, even though it is a slight breach of the high, look at how repulsive this high itself was, the high that caused the move down in the first place. Once the market returned to that level, we can see that we have the same thing happening. The market is moving away from that level with a little bit of a speed, right? Now, I want to highlight something to you guys. Remember, we said there is liquidity resting below all of these lows in here. Same thing is happening on the downside right here. Same thing is happening above the highs. And this is going to be the perfect illustration to show you guys what I mean when I say there is a cause and effect relationship happening at the highs and lows. Pay attention to this candle right here, you guys. Notice it is taking liquidity below this candle right here. Internal range liquidity rests right here. This candle opens above the low, trades down, takes liquidity, comes back up and closes right here. Now, on the subsequent candle, notice what we have. The high on this candle, once the market trades to that level, look at how repulsive that is. We have an immediate move away, and we have the continuation of the down move. Okay, what does that mean? We can use this information, especially on our lower charts, to say each time the market retraces and goes above a high, we can be looking for opportunities to go short. Okay, now whenever the market trades to a liquidity pool on the sell side, we know that there is likely to be sustained downwards movement, and we could have already gleaned that information from this candle right here, this candle right here, and this was the final confirmation that we needed. Okay, so if we were to follow along just a few more candles, once the market is trading below these lows, we are waiting for any candle to make it back to the high. Okay, and this is the first one that does that. It's trading above the high right here, and we can actually, I'm going to highlight this so you guys can see it a little bit more clearly. When you guys are starting out with these concepts, you want to annotate on your charts. However, you do not want anything obstructing your view of the candles, you guys. Imagine reading a book and you come across a quote that you like and you want to highlight it. You do not use a Sharpie to mark out that sentence, you guys. You use a highlighter, something that can make that line pop, make it more visible for you. When you were looking at your candles, it's literally the same thing, you guys. You are reading the language of the markets, and you do not want to cover the words. Just like you don't want to cover the words in your favorite book when you're reading, you do not want to cover the candles on your charts, because then you cannot see what's happening. Okay, so when you guys are annotating on your charts, make sure that it is not obstructive. That is very important. Now, pay attention to the high right here. Once the market trades above it right here, you guys, we can see that there was reversal, like in keeping with what we had so far with on this candle and on this candle also. However, we do have a little bit of a close on the subsequent candle to follow, and we will see it is also trading above these highs right here. Okay, now notice all the highs, once they are traded above, there is reversal, fast reversal at the highs. When the lows are traded, we do not have no such happening. The lows are being sustained. We are closing below the lows, and every time there is a retracement to a high, we can be expecting that the market to reverse at these levels. We can see that happening here. Now, we do have this down move that happened, and we will look to see when that shifted. When did the cause and effect relationship at the highs and the lows, when did that get reversed? When did the lows stop being repulsive? Now, once we have the market trading below these lows right here, and there is a slight retracement, we do have this candle right here, a little bit of a black sheep because it is closing above these highs. However, this in and of itself does not invalidate the cause and effect relationship, because notice, once the market is trading to the high on this candle, we do have that reversal happening, and there was a sustained down move right here. Now, where did this cause and effect relationship between the highs and the lows, where did it change? Because as we can clearly see, there was a up move to follow, right, all taking it all the way back to the top of the range actually, or almost at the top of the range. So what could have given us an indication in here to say, well, the market is no longer going to be moving lower when it goes to the highs? So when did that change? And in order to find that out, I'm going to highlight this candle's high right here. And we're going to get to that once we get to these candles right here. However, we do not want to just jump to this low, because remember, you guys, when we are studying, when we are backtesting these systems, we have to understand that this candle right here, we have to look at this as the most recent information that we have. Okay, everything to the right is imaginary once we are backtesting, and when we get to this candle, everything to the right has to be imaginary, you guys. We only have the information to the left of our charts. Okay, and when we are backtesting, we have to be honest in our practice, you guys. Honest practice is the only way to get better at this. We do not want to confirm any hypotheses that we come up with by looking at our charts. Okay, we want to test our hypotheses, and actually, if anything, we want to disprove any hypothesis that we come up with. We are trying to poke holes in our own system, you guys. That is the way how we get better at this. That is the way how we find defects in our system, is if we can literally try to poke holes in it ourselves. That is why we will find our flaws and our defects. Now, once we have the market trading below these lows right here, we are still going to be in keeping with the idea that once the market trades to a high, then we are still looking for opportunities to go short in the continuation of this move, right? So we have that happening right here, and we do not have a reversal. Whoa. So we wait and we wait. And on the next candle, we have it trading above the high again, no reversal. We do not need anything more than that to tell us that the highs are no longer repulsive. And pay attention, you guys, all of these lows, this will be where our external range liquidity lies. But this internal range liquidity, internal range, all of these lows, you guys, there is internal range liquidity resting below these lows. And notice, none of this liquidity is being tapped. Okay, we have the highs being traded to, the highs being maintained, market closing above these highs right here. We have a shift in market structure right here. And pay attention to all the lows are being like traded away from, and all the highs are being taken. Okay, now notice what happens the first time we get a sell side liquidity run. The first time the market trades below a low, then we have that reversal again. Being a trader, you guys, means you have to have the mental flexibility to change your mind every time the market presents you with new information. Okay, once we see this happening, take a look at this, you guys. This is a very important high that we highlighted right here. Okay, once the market traded above this one, this should be the last level to give us that reversal. And if we do not have that reversal happening right here, notice what happened on the subsequent candle. But once the market traded to the low right here, then we had that reversal. However, we have that reversal now to the upside. So this is where that cause and effect relationship changed. Now we are waiting for the highs to break. We are waiting for a close above a high. Again, for this, we had a first shift in market structure right here. The next close above a high is going to be our break in market structure. We have that happening right here. And we can clearly see the highs are no longer repulsive. They are no longer causing the reversal in price. And we have that happening below the lows. Take a look at this candle. Once the market trades below the low, we have that reversal. Same thing happening right here. Once the market trades below the low, we have that reversal. And a lot of lows are being left. Take a look at this candle. Once the market trades below the low, we have that reversal and we had that up move continuing. Okay, the same price is a fractal, you guys. We have this happening on our higher time frame. If we were to drop down to a lower time frame chart, we would be looking for the same phenomena, and that is what would be getting us into our trades. Remember, the higher time frames are used for bias. It's to get you a overview of what is happening in the markets. So we would see this happening a lot more on a lower time frame. Okay. Now, if we continue, we will see where we have a shift in market structure happening right here. And we're just going to look for that reversal again. Okay. Now, we have this candle's high right here. And we have the same thing. We have, once the market trades to this level, it is not sustained. We do not have a close above it. There is no shift in market structure. There is no break in market structure. And we can see that the cause and effect relationship switched again. That is what we're looking for, you guys. We're looking for where the cause and effect relationship changes. And if we can have that happen, if you guys notice, like I said, this is going to be an embedded technique, a layer on top of what we already have been using so far. You will notice it is happening right at our pivot point. We have that change in cause and effect between the candles that is happening right at our pivot point, you guys. Okay. So if you guys pay attention, like I said, this is an embedded technique, a layer on top of what we've been using so far. And we will see that change in the cause and effect relationship happening right at our pivot point that we have already selected right here. We still have our pendulum that will show you how we derived this pivot point, and you will see that we have the cause and effect relationship changing. Where is the change happening, you guys? Notice, like I said, every time the market trades below a low in all this up move right here, we were waiting for the market to trade below a low, run sell side liquidity, and then have that reversal. Now take a look at what is happening at the peak. Right at our pivot point, we have that same thing happening. The market is taking sell side liquidity right here. However, there is no reversal. Now, the first time that happens, that does not disqualify the cause and effect relationship. However, notice we have that happening again. The market is trading below these lows and no reversal. That in and of itself, you guys, should be, you do not need the market to show you this 10 times. By the time it's showing it to you 10 times, you guys, well, you did not participate in the move. You did not take advantage of the opportunity that was present to you. Okay, you do not hesitate once the market gives you that opportunity, you guys. And that is why we wait for those clear opportunities. Once those clear opportunities come, then we are not hesitating. And if you notice, the market is not trading above any highs. The market is breaking all the lows, you guys. We have our breaking market structure right here with the close below this swing low right here, you guys. And notice still no highs being traded above. All the lows are being broken. All the highs are being respected. So we can anticipate that the first time the market trades above a high, that is expected to be repulsive. And that is literally what we have happening. This is the first candle to take some form of a sell side liquidity. We do not have the immediate reversal after that. However, notice the level is the same. The level is maintained, and it is the same high. Once we get that run on buy side liquidity right here, you can see that the market is just, well, falling off. And if we continue cycling through, we can continue this, you guys, for all the candles. We can go and look at literally all the candles. That is how you are going to see this clearly. We see where that changed. We have a run on liquidity right here, no reversal to the upside. So we monitor what happens at the high. We have a run on liquidity, reversal. So we are still going short at the highs and all this down move right here. Take a look at this. We have a high. We have all the lows being broken. All the low, we are maintaining this downward move. All the lows being broken, all the highs being respected. And as soon as we have a high being traded to, that is when we have the reversal still. And like I said, you guys will be able to see this much more frequently on a lower time frame. Go down to your lower time frames on your own time and check these things, you guys. Now, to illustrate this to you a little bit more, I'm just going to randomly select any item on my watch list here. It's stopping on the same one, so we're going to do it again. Well, what are the chances of that happening, you guys? Okay, now we have randomly selected this market, and I'm going to go here on a lower time frame, and I'm going to randomly select anywhere. I'm just going to scrub back so that you guys can see I am not cherry picking these. I am not trying to fit these concepts to the market. This is literally what is happening in the markets, you guys. So I'm going to randomly select a level. I want to select a point where I have no annotations. However, that is, well, we can only go back so far. And if I'm randomly selecting a level, then this is as good as any. So I'm going to go over this fractal right here to show you guys, and it will be in a downward move, as you can see clearly right here. Whenever we are back testing, you guys, hindsight is 2020. Okay, we already have that information present to us. We have to use that to our advantage. Okay, we already have this information. We have to use this information to our advantage. Now, we're going to start at the top of the range right here, and we're just gonna cycle through and monitor the cause and effect relationships between these candles. We have internal range liquidity resting below this low, also this low. Notice what happens when the market trades to the low. There is a slight retracement, and take a look at this, you guys. I want to highlight something to you on this candle's low right here. Notice this candle, once the market trades to the low, it did cause that reversal to go all the way back to the upside. However, the market at the high on this candle sent the market falling right back down. So we do have sensitive lows on this candle. However, the highs are more repulsive. A lot of times you guys will find that to actually hold your trade, it's going to take a lot of wit. It is going to take a lot of you trusting in the system. And how are you going to get that trust in the system is from your own studies, is from you literally going through your charts and going candle by candle by candle, looking at this for 10,000 hours minimum before you can say, I am placing any trust in these levels. Okay, so if you do not have that, then you guys need to be spending a lot more time on your charts. Now, as you can see, we have the lows. This low in particular is very sensitive, and I wanted to highlight it because, like I said, we're going to get to it once we get to this level right here. However, we do not want to skip over anything. We do not want to get ahead of ourselves. We still have to go candle by candle, and that's what we're going to do. We have this low right here being traded, and this also caused a reversal for the market to go back to the high on that candle. However, we do not have to highlight this one also because it is literally at the same level. It is not this candle that is causing the reversal, okay? It is this price. The price level right here is what is sensitive. That is, yeah, it's very important that you guys understand that. So we do not have to highlight this candle right here because we already have a highlight in that price range right here, okay? Now, same thing is happening once we have the high traded to. We are having that reversal. This is going to be our shift in market structure. The first close below all of these lows right here inside of this liquidity pool. And notice what happens once the market trades to the high. Same thing, reversal, market comes down. And this is going to be a very important low. I'm going to go ahead and highlight this one also. This is our catapult level, and we can see that from here the market did trade higher and the market did take liquidity. We do even have a shift in market structure happening as a result of the market trade into this level right here. Okay, so we will see what information we can glean from the market whenever, if the market ever comes back to this level right here. We're continuing along, you guys, and we're going candle by candle. We do not want to skip over everything. And now once we've made it to this low, pay attention to what happens. Now, we do have sensitive lows right here causing the reversal. We do have somewhat of a shift in market structure. For some of you guys, this is going to be your higher time frame. A 5-minute chart can be your higher time frame, and you're looking for entries on a 1-minute chart. You're looking for entries on a 30-second chart. It doesn't matter, you guys. This is going to be a little shift in market structure. However, the first time that happens, it does not invalidate the move. Okay, we are still waiting for confirmation that the lows are now causing the market to reverse. And how that will happen is if we are maintaining highs. Once we close above the highs like we have right here, is the market maintaining these highs? Are we trading to lows and reversing? Once we get to the highs, are we staying above those highs? We can see that that is not the case. Once the market made it back to the high, this was our first sensitive level that we highlighted. Once we made it back to that level, notice we have that reversal and all the highs are being left. We have internal range liquidity above this high, above this high, above this high, above this high also. All the highs we have liquidity, and notice the highs are being left and all the liquidity below the lows are being taken. We can continue along, you guys, going candle by candle by candle, move by move by move. Like I said, I am introducing it to you this way because this is the way how you guys have to study it. Now, with me, my experience, I can just look at it and I can look at the entire move and I can say, okay, the swing lows and the swing highs, which one is more sensitive. But for you guys starting out with this, you have to go candle by candle by candle. Okay, you have to go over each individual candle and look for these cause and effect relationships like I just showed you guys. And I'm just going to continue. I'm going to come down to this low right here because I want you guys to understand when does that shift happen. Okay, so this is a down move. Okay, I'm going to use this candle right here. And for those of you guys who have been with me on the channel for a while, this pendulum should be popping out at you like that lady in the red dress, and the pivot should also popping out at you, also that lady in the red dress right here. However, we're not going to be using that for this lecture right here. We're going to be focusing solely on how we could be using the cause and effect relationships to get into our trades. Let's say we do not want to use a pendulum to find a pivot, and we don't want to wait for a move away and a retest on our pivot point. We just want to use the cause and effect relationships to get into our trades, right? How would we do that? I'm about to show you guys right now. Once you know how to identify the cause and effect relationships, what are you doing with this skill? Now that you can identify it, how are you going to be using it to execute on trades? You can use it as a standalone, like you do with the pivot, and you can also embed it on top of that. You can layer it on top of that one to give you guys better levels, okay? Now, once we have the market slowing down right here, we will see that we have this high traded too, and the market did not make it back to the low. Okay, this is the low right here, boom, that caused this reversal back to the high. This is the high. The market traded back to the high, and the high is not repulsive enough to send the market lower where it was just at this level, and now it is not even weak enough to go back to that level. Okay, now take a look at what happens. We have the market again trading above a high right here, and it is still not weak enough to get to these lows, to get to this low right here. What happens when the market trades below a low? Ooh, but if it trades below a low, you guys, you can see that the market is reversing and it is making it back to the highs. interesting. So we do have that cause and effect relationship shifting right here, and we can even glean that information before we have the pendulum forming, you guys. That is happening inside of the formulation of the pendulum. So for those of you guys who do not want to wait for the pendulum to form, you can notice I'm going to go over it again, okay? This down move right here came to this price level, this low. Once we got to this low, we had a reversal, and that reversal took us to this high right here. Okay, follow along, you guys. Now, once we got to this high, we are monitoring the cause and effect relationships at the highs and at the lows. So we got to this high right here. We know that the market is already weak enough from this level to make it down here. Now, we are back at this level, and the market is failing to go lower. We have a reversal. We have a trade above a high on this candle. The market is again failing to go lower. Once the market trades below a low, the market is not failing to make it higher. We have that reversal. We are closing above this high. This can be our first shift in market structure, and we would have to wait for a while. Guys, the same candle that is giving us our break in market structure is the same candle that is going to be our pivot, and that is also what we have before that, the cause and effect relationship being inverted, so to speak, because here we have that cause and effect relationship giving us entries to the downside. We have that inverse happening right here, and now we are looking for entries to go long. And we can see that when the market trades below these lows on the internal range, we can see that there is a reversal. And it's most of the time going to be like that, you guys. We want the internal ranges to be those sensitive levels. We do not want to wait for the market to get to the external range liquidity, because if that is happening, then that means that the highs are actually sensitive, still causing the market to go lower, and we do not want to set ourselves up for failure like that. Okay, we want to make sure that only one level is causing that move to get to the opposite side. If the highs are causing the market to reverse and go to the sell side liquidity pool, once the market gets to that sell side liquidity pool, if it's causing the market to go all the way back up to that buy side liquidity pool, then we're in a period of consolidation, you guys, and we do not want to be engaging with the market in those instances. We want clear opportunities. We want one-sided movement, okay? And we are monitoring all the internal range lows. Notice once the market trades below this low right here, we have that reversal. Market is trading above the high. We do not have the reversal. However, we have a little bit of a sell side. Liquidity take right here, and we have that reversal. So for this entire move up, you guys, we are just waiting to see once the market trades below So for this entire move up, you guys, we're just waiting for the market to tap into a sell side liquidity pool. And as you can see, all these retracements to these liquidity levels is supposed to be just a slight breach. Notice there is no deep dive into the liquidity pool. The market is not jumping in with both feet right here. It is just testing these levels for sensitivity. Is this level sensitive? We can see that it is. Market is moving away. Same thing right here. Just dipping a toe in the pool. Is it sensitive? It is sensitive. We're moving away. Same, and we can continue, and we can continue, and we can continue. But you guys should get the idea by now. I'm going to be using this concept going forward in the videos sometimes also, if it comes up, if those opportunities are present. I want to introduce it to you guys first before I start using these concepts to enter into the trades. Whenever we are doing live market analysis, I know sometimes I might mention a term. If you guys are unfamiliar with the term, then you guys have to let me know in the comments. You guys have to let me know in Discord, and I will try my best to simplify these concepts even more for you guys. For me, these concepts are simple because I have been practicing them. I have been implementing them for the last 4 years. And a lot of you guys are new to the channel. A lot of you guys are still struggling with your technical analysis. And that is why I'm making these videos, to simplify that for you, to give you guys a bit of an edge in the market. Okay, we are all here to try to find success, and that is why I am here, to try to help you guys to make these concepts very, very simple, very, very straightforward. Okay, now with that being said, I want you guys to take this information and I want you guys to go into your charts. Okay, I want you guys to go into your charts and look for these things. And if it is still not clear to you, come back and watch the video, watch it again, and then it should start coming back to you guys. It should start being a little bit more clear to you guys. And like I said, there will be myriad of examples of this going forward. This is just to introduce the concept to you guys. Okay, I hope you found this lecture insightful. Let me know if you guys need me to simplify it more for you. Let me know in the comments. Let me know in Discord. All the information will be in the description of the video. Okay, happy trading, you guys.